and welcome again to Learn How to Trade in 3 simple steps. This is expert level, and yeah, guys, you really made it, and that's why we want to walk into this topic right now. First of all, of course, as usual, disclaimer, risk disclosure. Please make sure that you completely understand that, of course, trading contains a high risk of losing money. I mean, it is what it is. Therefore, please always consider your risk management in a proper way, and please be sure to fully understand that if you trade on behalf of your own responsibility and, of course, on behalf of your own risk. So, saying that, this is me again for people who haven't seen me at all before. So, I'm a professional trader, author, IFTA president, member of the Forbes Finance Council, of the Newsweek Expert Forum, international speaker in, well, a lot of expos as well. And of course, I wrote some books. This one is the English version, also available in other languages, about risk and money management. And by the way, the thing that we discuss right now is how to find the best exits and work with stops is also covered in this book. So if you want to take a closer look to that one, feel free to read this in the book as well. So, I mean, what we generally need to discuss when it comes to the stop loss is that, of course, why do we use a stop loss? First of all, of course, we use a stop loss for a very simple reason. And the reason is that, well, we want to protect our most important asset that we have as traders, and this is, of course, our money, our capital, our working capital we use for trading, because it's simple as it is. If you don't have any money left, how can you trade? So, well, of course, you can trade demo account, but it's not really expert level, right? It's more basic or beginner, pre-basic level. So, of course, first of all, we need to have money. We need to conserve this. We need to protect our account, and that's why we definitely want to use a stop loss, especially if you trade with a lever, if you trade Forex, if you trade CFDs, if you trade futures. Yes, if you trade with a lever, you need a stop loss, no matter what, period. And I know all the discussions about it, and already recently I had a huge discussion with a friend, a trader, and we were talking about, hey, stop loss, yes or no? And he said, no, I don't need a stop loss. Yeah, maybe he's right. He's a hedge fund manager, and he's definitely playing completely different role and game than we do. And anyway, as a retail trader, you definitely need to have a stop loss again, because it's your money, you trade with a lever, and if you do this, you want to protect it, period. Therefore, a stop loss has a basic loss limitation function. You want to make your calculations upon this. You want to make sure that you have a risk-reward ratio, which gives you an idea if a trade is reasonable or not. So, of course, we already figured this out in the very last session. In the basics, the easiest way to place a stop loss is to set it in the area of a last low or last high. I mean, it's easy as it is. Or let's say you wanna trade with candlesticks or candlesticks formations. It's the same, because usually they are also last low, last high. By definition, these are supposed to be, because usually we trade candlesticks as reversal formations or reversal sticks, and therefore stop loss is perfect over there. So what you also need to take care of and be aware that people most of the time use a stop loss like this, but sometimes people are a bit lazy and also, well, not so sure about what to do in the markets, and then they place a stop loss not as a loss limitation or the risk protection. They place it as, let's say, trade ending stop. Like, let's say, with the idea that the market ends the trades and not the trader itself ends the trade. And you can do this, but it's not the basic idea of a stop loss, of course. So again, where do you place the stop loss? Of course, previous swing low, previous swing high, support resistance area, high low of a candle, of the formation, or if you're very aggressive, you just use the end of the entry candle or the end of each candle. So you can play around with this, and we will talk about this as well. And of course, all these variants, they have an effect of the money management matrix. Why? Because if you have a wider stop, you have different risk-reward ratio coming out. If you have a closer stop, you have, of course, you have a higher risk-reward ratio by definition. I mean, at least it's possible. And that's what you also need to consider when you talk about stop loss. So let's say you have, and this is basically an example with Apple right now. So you have your entry point in a weekly chart. It's 156, and maybe you're familiar with that chart because we used it already when it came to the money management and risk management. Let's say you want to enter at 156.45, which is basically I use that one. So you have right here, obviously already here you have an uptrend, right? And because it is an uptrend, you want to use, well, you already know that 1, 2, 3. This here is basically 1, this is 2, and this is 3. Maybe you want to have that one, but anyway, let's consider this is 1, 2, 3. Important for us is like this. So you have the breaking out point 2 gives you an entry. And of course, you want to place the stop loss underneath the swing low. So what happens with the chart? Market breaks. So, and as it happens, it always happens like this, you know. So what happens is the market breaks through the swing high, makes some points or dollars, and then drops. You know, you buy, as it always is, immediately into the correction of the previous move. That's what happens all over again with trend following strategies. Nothing wrong about it, but it is what it is. And of course, you need to consider this as well. So we keep it as stop loss number 1. This is a classic basic one. So you have like a distance of, what is it? Almost $14. So it's 156 to 142. Let's skip like, you know, this is cent. It's like, yeah, $14 as a distance between your entry point and your exit point as a stop loss. And already you see, you get out, you get into the trade, and then you go into the red zone, not feeling very comfortable, but well, it is also here that you have to accept that the market continues its move about impulse move right here. This is impulse, correction, impulse, correction. So that's basically the rhythm of the markets. And how to continue with that? Of course, there is another rule or another idea you can use. So we have stop loss number 1, which was here. And if you're very aggressive, this is your entry candle because your entry is with a breach of the previous high. So you enter here, stop entry. And if you're very aggressive, you just go underneath your entry candle. Wow, that's aggressive. But see what happens. You have like half the distance between your entry and your stop loss. Is this clever? You never know. But you have the chance, of course, to have a better, much better risk reward ratio than in the previous. And also, that's what you can see, you get a high risk in getting stopped out. This is the price you have to pay for a higher risk reward ratio. But see what happens after that. After your break, you get like a risk reward ratio under 1, coming back again, and you're already at this point, you have a risk reward ratio of 1, right? And if you just have your stop loss here, your risk reward ratio is like, let's say 0.5 or things like this. So that's it, what you need to consider when you place your stop loss. So you have, first one was 156 to 142, $14, and now you have 148. You have like just $8 of risk left. So you skipped already $6 as risk. But again, you see that this level obviously got tested several times. And obviously this one plays a huge role, not this one, but here, second one. Got tested again and again. So you can be lucky, like here, or you can be unlucky. It's just what the market does. It tests some levels. But in this case, you're lucky, so you got tested, almost got stopped out, and then at the end of the move, you see that you have a risk-reward ratio of 1-to-1, not so big at all, but you see market just moves sideways, tests again the market and this level, and then just continues the way up. And let's say you want to have whatever, 1-to-2, 1-to-3, 1-to-4, it's up to you what you're aiming for. But you see also that a high risk reward ratio is not easy to get, and also you carry either a high risk of getting stopped out, like here, or you carry a high risk of sitting a long time in a trade. Otherwise, it's not, well, you don't have that possibilities at all, you know. So if the market moves a bit slowly, it just takes time to give you a high risk reward ratio. And if it moves like really rapid, you see it's completely different story. You already know this chart, right? And therefore, this is what we covered in the risk management session, and this is what we talk about now. So anyway, you have two situations, you have two ideas of a stop loss, and therefore both are fine. This is more low risk and this is more high risk, and you have to pay a price for insurance like this. You have a lower risk reward ratio if you use the classic one, you have a higher if you use the aggressive one. If you use the aggressive one, the chances to get stopped out are much more higher than with the classic one. So why do I talk about this such a long time? Because people always struggle about the question, where do I place my stop loss? Because it's not easy, right? It's not easy to say, okay, we all want to have money. We all want to earn money with trading. The more, the better. But we always forget that taking that we have to take over a certain risk, and the risk comes the closer the stop loss is, well, the higher the risk of being stopped out is as well. So that's what I wanted to make clear with this. So, and also, if you're very, very, very conservative and very anxious, let's keep it this way, there's another possibility for you to, well, to place a stop loss. And this is where you don't have a high risk reward ratio at all, and it's not really something you can expect. It's just for, okay, I'm gonna invest, I give this stock quite a distance to move, like, you know, 30%, and this is where you have a high risk tolerance, where if you're like, okay, I want to be a long-term investor. This is not really something you want to be a trader, you know. So same entry, and then you don't say, okay, I want to be in here, like a little bit more conservative. This is where if you're like, oh my, yeah, I'm going to the, not to that low, I go to the previous low, this one. See, 1, 2, 3, so it's going to be this one. So you say, okay, I'm very, very, very conservative. I want to be really defensive. I'm thinking it's a good stock here. I want to be invested for quite a long time, like for years or decades maybe. This is the place you want to stop, because you don't want to get stopped out because of the movements of the market, which can be easily, let's go like here, you know, like this one, drops a little bit below the low and then just continues to move upwards. You feel like, no, I'm not into this. I want to be long-term, so your stop loss needs to be a little bit more far away. So you give it a little bit more room. But of course, it also means, especially if you're trading with a lever, not if you go and just buying stocks. I mean, if you just go by stocks, we talk about the weekly chart, no lever, this is the way to go. But if you say, okay, I have a lever, your position size will be very small, very, very small. This will be the highest position size. This will be a moderate position size. This will be a very low, very small position size, basically. because if you always want to risk the same amount of money, obviously highest size, moderate size, very small size. And also, even if you go to the high, just say it's a 3, let's say like it's 1 to 1 already over here. And if you want to go 1 to 2, it's like this, like a rule of thumb, you know. So this is your entry point, this is your distance. Around that level, you have risk-reward ratio of 1. Around that level, maybe here, anyways, you have risk-reward ratio of 2. See, the more distance you have to your stop loss, the more you have to wait until you have a decent risk-reward ratio in your pocket. It's pretty interesting if you're very interested, and if you're very aggressive, you have like 1, 2, 3, 4, 5, 6, 7, let's say 8. 6 to 8 depends a bit. 6 to 8 risk-reward rate. That means 1 to 6, 1 to 8 risk-reward ratio with a higher position size at the same level you have with a lower with that stop loss. So this means, and people always forget about this. Yes, you have a higher probability of getting stopped out, but the reward can be huge, right? It's like in life. You take over a huge risk, you want something big back again. You're not so happy with huge big risks. Okay, fair enough, not a problem at all, but don't expect too much gains from it, right? I mean it's quite logical, right? Isn't it? So if you're like very aggressive, yes, okay, you can expect more, or you get out very fast, having a decent profit, and you're out, you're gone, you wait for the next situation, enter again. And regarding our money management matrix, you have a higher, you remember, you have not really a higher hit rate, sure you might have, but also you have a higher trading frequency, which sits here, trading frequency, right? So you have a higher trading frequency with a tight stop loss. You might not have the highest, hit rate, but of course, your risk-reward ratio will be huge. At least it has the probability and the chances. This is RRR, whatever you might read in the CSR, by the way, right? Risk. So that's what we need to know if we discuss the 3 stop variants we can place. So again, stop loss level 1, stop loss level 2, and stop loss level 3. Most aggressive, a little bit more conservative, very, very defensive, maybe forever being an investor, being moderate, like short-term investor, being a very aggressive trader, right? So that's the idea with the stop loss and how we can play it and how we can use it. And of course, you can combine this idea. So depending on the size of your position, you can combine the stop loss. For example, let's say you have, maybe you want to buy 300 stocks, or let's say 90. Don't be that greedy. So let's say you want to have 90 stocks of Apple in our example. So what can you do? Of course, you can say, okay, I want to be not really aggressive, like going all in with a high position size, with a very aggressive stop loss, with a high probability of getting stopped out and then cashing in the loss. But still you want to be in a position where you feel like, yeah, but still I want to have a decent risk reward ratio, at least with a portion of my position. And also you want to feel like maybe a little bit more long-term oriented. I feel like, yeah, let's give it a little bit more room to move. Maybe you want to play around a bit if you get stopped out with a very aggressive stop. And let's see how things turn out. Maybe you find another re-entry with a position. So the question is, how can you how can you play around with these three ideas? So maybe you want to place 1/3, which are 30 stocks of your position on the, well, stop loss number 1 on the swing high or the swing low. In this example, it's a swing low. Maybe you want to place also 30%, like 30 stocks, on the low of the candle or the candle formation, like we discussed right before. Let's say the very aggressive one that gives you the opportunity either to exit this part with a decent risk-reward ratio within a given short time, or to give you the opportunity to pocket a huge risk-reward ratio. Both is possible, right? And maybe you want to place 30%, so 30 stocks below that one, where we say we're very conservative, very defensive, like it's like, well, you want to hold the stock forever, really give it room to move, but still, okay, if it ever reaches your goal, it will not be a very high risk reward ratio, but you could stay in this position forever because your stop loss is so far away that you don't have to worry about anything. You just sit and wait what happens. See, so these are the ideas, and of course, by doing this, you might get stopped out with 1/3 of your position, but still you have 2/3 in the market, and then you can see, okay, I just got some money back, not a big deal, but I'm liquid again, and I can re-enter, the very moment the market gives you the opportunity to jump back in, maybe with the next breakout or maybe with a candlestick, still getting into the trade, maybe for a better price, and then having also the chance to get back in the market with a full position without risking too much. Therefore, you don't need to limit your profits that much, but you still can limit your losses. So again, it looks like this. So you have the 3 stop losses, and the moment you enter here, maybe you're lucky and everything goes into a direction, but maybe also it's like you get stopped out, but still you have this one in play, like 1/3, and you have this one in play, 2/3 of the position, and maybe you want to enter here again, or you want to re-enter. Let's assume you got stopped out here, so you can re-enter here, place a stop loss there, not a big deal. Okay, it gets choppy again, but still your stop loss is valid. Maybe you want to re-enter here, maybe you want to re-enter here. See, there are so many opportunities. Maybe you want to re-enter here. So there are so many opportunities to come back with a part of your position that it always makes sense that you work around with your position a bit and not just go all in with one trade, but that you make not one trade, but you make 3 trades out of it, right? 3 portions of one trade. Of course, also this has an effect of your risk and money matrix, because if you really keep it strict, you don't have one trade in your journal. You have 3 trades now in your journal with 3 different outcomes, with 3 different management types. But still, in total, it's 1 position. So this gives you the opportunity to be everything: aggressive, moderate, and very conservative. You can be everything. You don't need to be aggressive at all, but you don't need to be an investor for life as well. You can be like parts of it, and it makes pretty much sense, doesn't it? So as a conclusion for this, and then we go over for some practical approaches. As a conclusion of this, when you place a stop loss, of course you have some options. So you need to weigh up again and feel about, okay, do I want to have a quick exit, just hit and run? Or do I want to hold this position because I believe in the move of the market, I believe in the trend, I believe in in the stock. I believe in the management, like an investor does. So it's on you if you want to be aggressive or you want to defensive. And if you combine it, you can be both. Everything. You can be aggressive with one part, and you can be conservative defensively with another part. And so you lower your risk, but you still give the opportunity to get big profits. And I think this is what we need to be, what we need to do, and what we need to do. And also consider this, and then we go into practice and we go into the chart. Consider this, that if you get stopped out, what does this really mean? Of course, a broken stop loss can be a successful new trade on the opposite side. So even though you feel like, I don't want to get stopped out, put it like this way. If you get stopped out, maybe you want to go into the other direction and trade the way the market's different way. So let's see for the practical side of the market. Let's see what we could have done with the S&P 500. So let's say, oh, I like that one. We already discussed about, here we go. Yeah, we already have discussed about our reversal formation. This is 1, this is 2, and this is 3, right? It's a daily chart of the S&P 500. This is the future. And yeah, what we see, this is a reversal, right? And you want to exit here. There is a break right here underneath the low. This is where you enter. This is where your stop loss sits. Basically, right now we have stop loss 1 and 2 at 1. That is 1 and 2, because we have the swing high here, and also it's the end of the entry candle, right? So it's both. And if you want to be very conservative, this is stop loss number 3, right? So obviously none of these stops got hit. And of course, if you have like only, this is the right one, if you only have the very conservative stop loss, your position size will be very small. I mean, you have almost, let's say it's 4,350 as an example. So you have like 250 points of the S&P as a distance from your entry to the stop. Around 250, or let's say 300 points, doesn't matter. So 300 points distance. If you have the moderate, and also here in this case the aggressive stop loss, you have, let's say, 150, and it's quite obvious that you could have a double position size, of course, a higher likelihood, higher probability of getting stopped out anyway, but that's what you see. So market drops, you enter here, let's say you have your stop loss here, it never got hit so far, right? So question always is, where could be your stop loss then, your profit taking then? So you want to enter here, you have your stop loss here, and let's see. This is 1 to 1 already. This is maybe 1 to 2, something around this. Then you get the whole distance back. So, and if you really are like trend following, you need to live with the fact that the market, after you have been into a very profitable trade, you have to give back everything and a bit more in order, and with the hope and the expectations that you get even more when the market continues its move. So this is the price you have to pay on the mental side for a higher profit. So turns out, if you don't want to get out here, which is one of the logical past targets, that area about the highs and the lows, which is now a support area, you have a 2 to 1 risk reward ratio, right? You get back to 0 and below to get at this area as 3-to-1, and you get a reward for all the pain you went through with this distance of one more with this 4-to-1. And you also see this is the logical and quite the natural profit target for a short trade. It's always the previous low, and you see also that the market breaks through, but it comes back quite easily and moves a little bit sideways, and now returns to the upside, gets stuck at the support, resistance, and resistance again, comes back again, drops it again today and the previous days before last week. So this is your natural and pretty logical profit target for a short trade. So to sum it up, what you can see here with a classic and also aggressive part, you could get to the maximum 4-to-1, right, as a risk-reward ratio. And what you need always to consider is that in order to get a bit more of risk-reward ratio. If you don't like it, the first profit target is yours, and then you need to exit the trade. That's basically the idea behind that, and that's basically also it. If you have a very defensive profit target, a very defensive stop loss, you see, you might have, this is 1-to-1. Here you go, still everything back, and even though as a natural target, you have something like 2-to-1 as a risk-reward ratio with a lower position size, a smaller position size. So let's say you have not only double with a move of the risk-reward ratio, you have also double with position size with more aggressive profit, more profitable target, and therefore this is a more profitable trade. So the question is also here. Oh, there's a question. Your stop loss should be a reflection of volatility. Yes and no. You can do this. You can use like ATR indicator for this, which gives you the average to range, which is something to measure also the volatility of previous days. It's like, you know, formula. But using candlesticks and also the idea of support and resistances, highs and lows, which are natural supports and natural resistances as well as profit targets. If you use those, you can also measure the volatility, because these ones for us are natural by definition, because they are highs and lows, natural resistances, natural targets, natural supports, and therefore also places for our stop loss. And yes, you can also combine it with different other things, but usually for me, candlesticks are the way to go. Or maybe also, we want to do it with ATR, and you can then play around a bit with the settings of the ATR as well. Yeah, that's true. Right, so what does this mean now? I mean, in general, you always have to consider what kind of trader you are. If you're more defensive, you will never feel comfortable with a tight stop loss. You will always feel like, oh, I don't want to get stopped out. I don't feel like I want to lose money. You need to have a stop loss, but it's up to you where you place it. But if you place it a little bit more far away, you need always to consider, first of all, there's a price to pay for that. First price is you have a smaller position size. And second price is don't expect a huge risk-reward ratio. It will not come, right? And if it comes, it takes ages to arrive. Therefore, if you're more defensive, you need to be a little bit more, well, let's say, humble when it comes to the results. If you're aggressive, yes, you get hit hard, and you get hit quite often because you have a tight stop loss, you get stopped out quite, not always, of course not, but well, from time to time this happens. Maybe it happens also by bad luck, but still you can afford this. That's one thing, because if you're profitable in a high amount, like high risk reward ratio. And if you're profitable, of course, you're not just profitable with high risk reward ratio, but also with a bigger position size, which gives you the double effect of a good profit. And if you ask me, Wieland, what kind of guy are you? And I can answer you this question very easily. I'm more the aggressive guy. So I'm very comfortable with a tight stop. Why? First of all, I like the idea of having a good risk reward ratio in a reasonable time. I don't want to sit in a trade forever. I want to have fast results. I want to know where I am. I want to know what happens. I don't want to wait forever. I prefer getting stopped out over waiting for a result. Crazy, right? But this is me, and you have to decide for yourself what you want to do and how you want to place your stop. And basically, actually, this is what I wanted to show and share with you in this session. It's little bit shorter, but not bad at all, I guess. So if you have any questions, I'm open to discuss. Happy to discuss, because we have quite some minutes. But if not, I'm also happy to end the session and return also with some outlook for the next sessions, what we do the next times. Gone. So this is money management 2.0. So scaling in and scaling out of position, and increasing, of course, potential profit without changing the risk. So next time we want to talk about psychology. I mean, trading, honestly speaking, it's all about psychology. It's not about the perfect entry. I think we already answered this question several times during this our common sessions, but it's all about psychology and management as well. I mean, management still is psychology. So we want to talk about greed and fear. We want to talk about how greed and fear also affect trading decisions. FOMO, fear of missing out, FUD, like, fear, uncertainty, and doubt. These are our companions while we trade. This will always happen, that we have emotions, that we fear losing money, we have greed of having even more money, and we need to deal with this because we're humans. We can't get rid of our emotions, and actually we don't want to do this. So we need to discuss this, and we want to do this next time. We want to talk about goals. I mean, with the chart of the S&P 500 and also with the Apple chart as an example, you already saw that having goals like, okay, where do I want to exit my trade, is quite a good idea, because if you don't have a goal, where do you stop? So you sit in the trade forever, being profitable, then losing money, being profitable again. Therefore, yeah, you need to have a profit target to exit not just only your trade, but also your trading day. And of course, we want to talk about perception. Perception is something we have every day, every time, always. And of course, this means that we have it also as traders. But what's interesting is that as traders, we have a different type of perceptions than as normal, regular people. And we want to discuss this as well. So there's a question always coming in: no discussion of options as a means of risk control. I don't get it really, Bill, what this means. No discussion of options. So this means, okay, if I don't have any option, I control my risk. I don't get this. If you want to clarify it a bit, I can answer this, and I'm happy to do so. Okay, buy an option has a defined risk. Yeah, option as a trading product, like a future, like a CFD. Okay. Yeah, I mean, there are several products in the market you can use. I mean, in Germany, especially in Germany, we have something. These are not quite options, but these are like certificates. Quite complex products. they have a defined risk, because if you buy them and you reach a stop, they get, well, completely worthless. So they just vanish. Using options themselves, I'm not the option guy, honestly speaking. I don't trade options, but yes, you can have a defined risk, but still you can have quite a bad risk of losing money because they don't have a natural stop loss. And yes, it could go to zero, but I'm not so sure if you don't have to, well, put a little bit more money into it if you or you have to buy things if you get your option, or you have to sell things if your option gets fulfilled. So it's not that easy saying, okay, I have an option and don't use the stop loss. It can be expensive as well, for sure. Everything can be expensive if you don't watch it. So from my point of view, let's see if there's something else. No, okay, that's it so far. Right, and then module 3, we want to talk about indicators, and then module 4, like at the end of November, we want to talk about horizontal trading, so sideways strategies, how to trade a box, all these little ups and downs we have, we can discuss this as well. And again, if you happen to be somewhere like in the Philippines, where I'm right now, happy to meet, give me a call, or just hit me somewhere, on Instagram or Facebook, hit me up over there. And in December, I will be in Kuala Lumpur and Singapore as well. So maybe also there's some room for a meeting, would be happy to do so. And also I will hold some lectures here in the Philippines, with the STA of the Philippines, and also with Marta in Kuala Lumpur, and of course with our friends in Singapore as well. So I don't want to steal your time just by talking about nothing. So see you next week when we talk about the inner trader, and hope, well, you had a good time. See you next week. Have a great evening and great day so far, wherever you are. And until then, bye-bye.